It's always important to stay in the know, that's for sure. You know, exactly. Alright, so let's see here. Okay. Alright, so let me go ahead and start the screen share. Alright, so let's go ahead. Yeah, let me go ahead and start the recording now too. 1 second. Let's see. Okay, there we go. Alright, so thank you everyone for being a part of this Tax Tips for Realtors webinar. The purpose of a webinar like this is to engage those who are realtors and to make sure that you're doing things that you have to do in order to truly run your real estate business. And we won't cover it today, but oftentimes real estate agents tend to also be real estate investors. And we always encourage that type of behavior because the tax benefits just go through the roof anytime you are a real estate agent and then also a real estate investor. And so last month, we do have a webinar a month after tax season. But last month we were able to cover tax tips for real estate investors. So we're talking about the actual property. Today we're here to talk about how do you run your real estate business as a realtor, right? And the same principles that apply here can also be applied for any active business. Maybe you're a contractor, maybe you're an inspector, insurance agent, even an Uber driver, whatever it is, but we will gear the conversation here towards realtors. So that's the specialty today. You're probably wondering why realtors specifically. It's because most of my clients are actually realtors, believe it or not. I do a lot of workshops, a lot of webinars. I've done a few for groups such as Keller Williams, at properties. You have Premier Midwest Real Estate. So there's been quite a few groups that I've done these presentations for, and they've always left with something valuable out of it. So if basically what happens with webinars like this, if you do have any questions throughout, you can always ask it at any point. But let's go through the agenda real quick. So I'll start by introducing who I am and also my firm. I'll give you guys just a background about incorporation, just why it's important to incorporate, what you need to do, and just before we get into even taxes, we need to make sure that you're set up correctly. Oftentimes, realtors or real estate agents are not set up correctly, so we can't even talk about taxes if you're not set up correctly. So incorporation, and then we'll go into the taxes. Of course, this is the tax tips. You'll notice that we'll spend actually about 20 minutes talking about stuff before we even get to the taxes. And then how do you keep track of all of this stuff? We use software such as Quickbooks. But throughout the presentation, you can feel free to ask me any questions that you want. So if you're on Zoom, then you can just unmute yourself, or you can type into the chat box. If you're on Facebook and Instagram, which we're streaming live on today, then you can certainly type your question in the chat box. So who am I? My name is Jeff Badu. I'm a licensed certified public accountant, or CPA for short. I'm a University of Illinois Urbana-Champaign graduate. Got a bachelor's and a master's degree in accounting. I'm also a parallel entrepreneur and a wealth multiplier. I'm the founder and CEO of Badu Enterprise LLC, which is a multinational conglomerate in the finance industry. And what we do is we provide a suite of financial services to individuals and businesses all across the globe. The marquee company, which is the company that is powering this presentation today, is Badu Tax Services LLC. And that's a tax firm that does tax preparation, tax planning, and representation for individuals and businesses across all 50 states in the U.S., as well as having clients right now in over 15 countries. On top of that, we do also run Badu Investments, which is another marquee company. And that company is a real estate investment company. We buy multifamily rentals primarily on the south side of Chicago. We invest in properties anywhere 10 units and above. So some people call that commercial real estate, but then it's also still part of the residential, since we are providing, we're providing housing to actual individuals or residents for short. But we do use commercial loans in order to get these types of properties. We don't use residential loans, and so that's why it's a bit confusing, but sometimes basically the category of the real estate is still in residential, but the type of loan used for these buildings is actually commercial. But in general, I'm very passionate about financial literacy. That's why I'm delivering this presentation today. We just launched the Badu Foundation a few weeks ago, and our first program was held last Saturday, and our that same program is going to continue this Saturday as well. And it's basically the Badu Foundation is a financial literacy foundation that's meant to provide youth and homeless people experiencing homelessness with an opportunity to enhance their financial literacy, education, and their financial literacy skills. And so what we do is we have a 2 to 4 week program that we host throughout the year for the students, and we teach them how to manage their money. We play a game such as Cash Flow, which is a game that the moment I played that game, life definitely became a lot better because I learned certain principles about money. So we're basically teaching the kids this, and then at the end we will select a student to get a $500 scholarship to a college of their choice. So that's a little bit about what I do, but now let's get right into the presentation. So business incorporation, it's very important to be set up correctly when you're running a business, especially as a realtor or a real estate agent. Now, there's really only 2 different types of entities, but you can break them out into 3. The main 2 types of entities are LLC, which is limited liability company. So LLC is, it's basically short for limited liability company. And then you also have a corporation, or you call it INC or corp for short. So those are really the only 2 types. It's the LLC, limited liability company, and then the corp or corporation. Now, the thing is, so let me cover a little bit about the LLC. Actually, let's take a step back. Why in the world should you even incorporate yourself? The first thing is it enhances your credibility. It makes people take you more serious when you are presenting yourself as a business as opposed to an individual. Me personally, I only work with vendors that have a business entity behind them. So that's just me personally. My contractor, my inspector, my real estate agent, they all have entities behind them. They all have some sort of business. Because me, I'm not comfortable working with somebody who's operating in their personal name. That's just me though. But I've noticed that a lot of people also have the same sentiment. So it's definitely important to, if you truly want to for people to treat you as a business, then you have to treat yourself just like a business. And the first thing is incorporating yourself and becoming a business. The second reason is to protect your personal assets. So when you have an LLC or an INC, you actually protect yourself from any liability of the company. Basically, when they sue you, they can't win anything that you own personally or outside of the company. They can only take what's within the company. And then last but not least, it gives you easier access to capital. So you cannot apply for business loans. You cannot apply for business credit cards without having some sort of business entity behind you. So in general, it's just good. Some people ask, well, when should I incorporate myself? I say as soon as possible. The moment you realize that you want to get into business, you should incorporate yourself. Now let's go back to the top and talk about the LLC and the corporation. So one thing that some people may notice is all my companies end with the words or the letters LLC, limited liability company. So all of my companies, except for one, which is the Badu Foundation, which had to be a corporation due to the nonprofit, the 501c3 status. All of my companies are LLCs except for one. All the 12 businesses within the enterprise are LLCs except for one company, which is the Badu Foundation. Why is that? We like the LLC because it's very easy to maintain. It's easy and flexible. It's simple. Right? For me, simplicity trumps complexity all day, every day in my world. So LLC is very simple and easy to maintain and operate. All you really need is to form the LLC through your state via articles of organization, get your tax ID number, and a business bank account. Now, you might want to add an operating agreement to it, just a template or a document that states what the company does, what it's all about, who owns the company. Just a good document to have. As long as you have those 4 things in place, you're good. So it's very easy and simple to set up. So it's low maintenance. That's one of my favorite things about the LLC. It protects your personal assets, so nobody can sue you and gain control of your personal assets as long as you're not doing what's called piercing the corporate veil, which basically means that you're commingling, you're mixing business and personal together. So as long as you're not doing those things, then the LLC will fully protect you from any sort of personal liability. Another reason why I like the LLC is because of the fact that it gives you options. It gives you flexibility. You get to choose how you want to be taxed as an LLC. You can be taxed as a sole proprietorship, which you would file a Schedule C on your individual 1040 tax return, which would also subject you to FICA, the self-employment tax, or the Social Security tax that businesses have to pay. That's about 15% each year. And then you also get to choose a partnership tax structure. Partnership is 2 or more people, and it has the same thing as the sole proprietorship, except you file a separate business tax return called the 1065 partnership return. And with that, you're still subject to the FICA or self-employment tax, the 15%. But now, how do you avoid the 15%? You elect to be taxed as an S corporation. An S corporation helps you avoid the 15%. So why do you see some people set up as a corporation or S corporation? Is because you get to avoid the 15% FICA tax. By the way, that 15%, when it's all said and done, when you do your calculations, it turns out to be about 10% because you get to deduct, quote unquote, 1/2 of the FICA as an adjustment, not necessarily as a pure tax deduction. So that's one thing to note. So it is 15% as the FICA tax rate, but in reality, you end up paying about 10% if you really sat down and did the math on that. So if you want to save 10% on your taxes, if you're an active business, whether a real estate agent, a contractor, Uber driver, whatever it is, if you want to save about 10% on your taxes, then you should consider electing to be taxed as an S corporation. So that's the primary benefit of being taxed as an S corporation, is because you ultimately get to avoid the self-employment tax or the FICA tax. So that's something important to note there. Or you get to elect to be taxed as a C corporation. With the C corporation, you get double taxation, meaning that you pay taxes on both your profits, and then you also pay taxes when you pay yourself money. So when you're a sole proprietorship, a partnership, or an S corporation, we call these pass-through entities, then ultimately you don't necessarily have to pay taxes when you pay yourself money in the form of a distribution. So let's say you made $100,000 for the year, then as an S corporation, partnership, or sole proprietorship, you only have to pay taxes on the $100,000. Even if you paid yourself the entire $100,000, or if you paid yourself $50,000, you still only pay one tax essentially on the $100,000. Now, if you're a C corporation, though, if you made $100,000, you pay taxes at the C corporation tax rate. But then if you paid yourself up to $100,000, let's say, you have to pay an additional taxes at the dividend rate, which ranges anywhere from 0 to about 20%. Most people pay about 15% on that. So that's why C corporations are typically not recommended as a tax structure, because of that double taxation, especially when small businesses are known to be paying themselves quite often throughout the year. So that's something good to note, is that the LLC gives you that simple structure. It gives you the simplicity. It also gives you the ability to choose how you want to be taxed. So it gives you that benefit of a corporation or an S corporation. And then last but not least, it protects your personal assets. So it gives you that shielding and protection. So for me, I'm all in on LLCs. I love it. It's simple, but it also gets me exactly what I need. So then you have the corporation. Now there's a C corporation, then there's an S corporation. An S corporation is simply a C corporation that elects to be taxed according to IRS rules and regulations as an S corporation. Right? So with an S corporation, it also protects your personal assets. It gives you that benefit that I just mentioned as far as being able to save on self-employment taxes, that 15%, which effectively becomes 10% when you do the math, as far as how much you have to pay out of pocket in additional taxes. So S corporation is great because it helps me save about 10% every single year on my taxes, right? So that's a huge benefit. I don't have to pay this FICA or the self-employment tax. That's a huge tax planning tool that we use for all of our clients that we offer. Tax planning is actually our number one service in the firm. So that's something to note there, with the S corporation. Now with the so basically with the S corporation, one thing that I don't like about it as far as a standalone corporation is the fact that you have to ultimately, it's high maintenance. You have to have bylaws, stockholder certificates. There's a lot of different things that you have to have when you're setting up a standalone corporation. Now we're talking about a corporation that elects to be taxed as an S corporation. We're not talking about your standalone LLC that just needs to have an operating agreement and articles of organization. So we're not talking about that type of company. We're talking about a corporation that elects to be taxed as an S corp. All corporations are fairly high maintenance, so you do need to have your stockholder certificate, and then you also need to have your bylaws. Your attorney can help you set all of those things up, but ultimately it is something that's needed and required for your corporation. And you also need to have board meetings or board minutes to prove that you have a corporation. The reason why we keep these things on file is that if somebody sues us, then ultimately we don't necessarily have to pay out of pocket outside of the company. Let's say in the event they win a lawsuit. And remember, C corporation has double taxation, meaning you pay taxes on both your profits and the distributions of the company. So that's one reason why I don't like C corps. C corps are great for big companies such as Apple, Microsoft, and Amazon. Those companies have to be C corporations because they are public companies, although they might have subsidiaries who are LLCs and things of that nature. So it's very important to incorporate yourself because it enhances your credibility, it protects your personal assets, and then it also gives you easier access to capital. And then as an added benefit with the S corporation, it gives you that tax benefit of being able to save on about 10%. And then also it gives you the ability to do tax deductions and things of that nature. So it's very important, whether you're starting out as a brand new business or you're an already established business, you should be setting yourself up from an incorporation standpoint. And this applies especially to realtors, and then also any sort of active business, such as an insurance agent, an inspector, anybody that's actively running an active business, essentially. So that's it with that. Just wanted to point that out. I do see that we might have a question. So the question is, can an LLC elect to be taxed as an S corp starting out, or should they be making a certain amount before doing that? That's a great question. Yeah, I would say if you're making $30,000 or more in net profit, so profit equals income, money coming in minus expenses, money going out. So that's your profit. Income minus expenses equals profit. If that profit number is $30,000 or more, then you should definitely consider electing to be taxed as an S corp. And we can definitely help you set those things up. That is a core service that we do offer. So $30,000 profit is the threshold that we typically use, where it probably makes sense to be taxed as an S corp. And by the way, how do we help, or how do we engage our clients, or how do we proactively tell our clients this? Is after doing a client's tax return and they're not set up as an S Corp, we literally drill down all of our Schedule C clients and we filter for their profit. If the profit is $30,000 or more, then we immediately engage them and say, hey client, we might benefit from moving you to a more complex tax structure. So that's the way that our service works. Just to give you a little bit of insight, in case you're wondering, well, how does our client know, or how do we proactively engage them, is that we run that filter and we're able to tell the client that. Question here is, do you need stockholder certificates for an S Corp or one person? Yes, you do. If you have a corporation that has even just one person, yes, you do need a stockholder certificate, and you can print that online, or you can consult with an attorney to get that. How would you have a board meeting with an S Corp or one person? Hey, it only takes one person to have a company. So you can actually, and we'll talk about this in the next on the next slide, but basically you can have board meetings. You can have nice fancy trips. You can go to Cancun, you can go to Zimbabwe, wherever you decide to go, and have your board meeting there. You simply need to have board minutes where you document the name of the company that was present, the people who were present at the meeting, what items were discussed. So we do have templates available. That's one thing we offer to our tax planning clients, where we actually help them get their board meeting set up. If you want to use an attorney who documents these things for your board meeting, then that's fine. Hey, Apple, Microsoft, these companies all have board meetings in fancy places, so why shouldn't you? If you want to do it in Chicago or your local city, then that's fine too. But one way to leverage the benefit of an S Corp, or any company for that matter, is ultimately you get to travel to nice places and claim that you have at a board meeting. As long as you have a document that proves that you had your board meeting there, the IRS cannot do anything to you. It's clean, it's documented, you signed and dated it, and you put it in your files. If they ask for it, if they ask, why did you go to Mexico and spend $3,000? Well, you can say, I had my board meeting. Here's my minutes. Do you have any questions? They might ask, oh yeah, show me a receipt of expenses. Well, here you go. Here goes the folder too. So one thing we try to prepare our clients for is how to be audit proof when it comes to the IRS. As long as you're documenting these things, as long as you are being proactive and you're treating yourself like a business and not an individual that's just doing things on their own, then you'll be fine. You'll be perfectly fine in that regard. So it's very important to have these things in place. You should have an attorney on your team. You should have a legal counsel on your team, and you certainly should have an accountant on your team if you want to implement some of these strategies that we're talking about. I have some clients, especially realtors, who don't pay any taxes during the year legally because their real estate business has a lot of tax deductions within it, and any profit that they make, they reinvest it back into a property that allows them to do cost segregation and things of that nature to wipe their tax liability down to zero. So we do have clients that pay no income taxes legally. So it's, when it comes to taxes, it's really strategy. And if you don't think this is important, 40% of a person's typical income, money that's coming in, usually goes to taxes. So if you don't think this is important, then you might be comfortable giving up 40% of your hard-earned dollars to the tax man, the IRS, Uncle Sam they call him. Uncle Sam can be quite greedy if you know who Uncle Sam is, or if you know his tendencies. So this is extremely critical. You're talking about 40% of a person's well-being, 40% of a person's budget going straight to taxes, and then another 30 to 40% going to their housing, which is another thing that we teach within our Badu financial fitness program, is teaching you how to eliminate your mortgage payments by having somebody else pay for them. So effectively, through my firm, we can literally save you about 70%, up to about 70% when it comes to your budget. We can literally wipe out 70% of your expenses just by putting some of these things in place for you. Now let's go to the next slide. So now we can talk about taxes. Right? We first started off with incorporation. Right now we're at about 12:29 Central. So we typically spend 20 to 30 minutes before we even touch upon the topic of taxes. The reason why is because I want you to know how important it is to do the whole incorporation thing. As long as you're doing things right, you're not cutting corners, you're doing things by the book and ultimately taking advantage of the rules that are available to you, you'll save a lot of money when it comes to taxes. Even if you have to pay somebody to help you, so what? You're saving up to 40% of your budget. That's huge. That is a ginormous number, 40% of your budget. And back in the day, it used to be 60%. The highest tax rate in the U.S. back in 1944 was 94%. So we're talking serious dollars. Some people say, man, why do we have to file taxes? Why? Because it's the law. Right? It's just like getting a driver's license to operate a vehicle. It's the same concept. The reason why we have to file taxes is because we're legally obligated as U.S. residents to pay taxes and to file taxes. So that leads to the next slide. Why should you file taxes? Well, because you earn an income. If you earn, and the number is actually $400 or more as a self-employed individual, somebody who runs a business, you must file a tax return. Some people say, oh, I only earn $1,000. Do I have to file? Yes, you do. What happens when you don't file? The tax man knocks on your door. Nowadays, they send you a letter saying, hey, you should file your, you need to file your taxes. You get a letter in the mail saying, please file your tax return within the next 90 days. They will send you that letter. I've seen that letter before for some of my clients. Let's say you let 90 days go by. You say, oh yeah, forget the IRS, who are they? They'll send you a second letter. They'll knock on your door the second time via letter. And they say you owe a proposed amount because they received 1099s that are in your name. So before you get to see a tax document, the IRS actually gets to see it before you. All your W-2s, all your 1099s, the IRS has them in their possession already. They're just waiting for you to file so that they can see whether you owe money or whether they owe you money. So if you don't file, you will get a second letter saying, hey, you owe this amount because of the 1099. And they'll add interest and penalties. And of course, they don't know your expenses, so they'll take it at the full gross amount, essentially. Basically, that's the amount they're going to tax you on. Now, if you say, oh yeah, screw the IRS, who are they? You'll get a third knock on the door saying now you're in collections. Now you really, really, really owe us some money, right? So basically, with that third letter, they will give you some time. They'll give you about 30 days or so. But if you say you're not going to pay within 30 days, then they're going to issue a collections to your account. So with that collections, luckily, it does not go on your credit report, but it definitely is something that you do have to pay. So once a collection is issued in the form of a levy or a judgment, they can seize your bank accounts. And I have clients that their bank accounts have been seized because of this. They can take your car. I have a client whose car, he was literally driving, he parked the car at a gas station for, I think he was spending some time in there. Next thing you know, he sees a tow truck towing his car, and he asks him, what's his tow for? And he says, the IRS has decided to seize your car. And I've heard similar stories with Lamborghinis and all types of crazy cars. They can come and knock on your door and take your house. So they can legally basically put a lien or a levy on your house and get a sheriff to escort you out of your own home. Can you imagine? They can take anything that you own, they can come and take because they have a legal levy on your assets. So that's serious. When somebody has a levy on you or a lien, that means they have legal rights to that asset. So it's nothing to be played with. You ultimately should file every single year. Even if you don't think you should file, I think you should still file anyway. Of course, stimulus checks and things of that nature came out, and only those who filed or those who made an attempt to file were the ones who received the stimulus check. We typically file annually, so we file once a year, and then we also have to potentially make quarterly estimated tax payments if our net profit is, if our tax liability for the prior year was $1,000 or more, and then also if our net profit, if we're expected to generate a profit, we would make sure we send the IRS and your state some money each quarter so that you don't owe this big bill or this big lump sum at the end of the year, and also you avoid penalties with that too. It can also get you a refund. So when you file your taxes, you either get a balance due, a refund, or a zero due. A zero due is typically the most ideal scenario. But once you file, when you do file, you tend to get a tax refund if they're due a refund, meaning that you overpaid throughout the year. Maybe you had a W-2, or maybe you had kids and you qualify for credits, a child tax credit, earned income credit, or maybe you're in school, American Opportunity Tax Credit. You can't get these credits unless you file. Right? Only those who are hungry and those who take action will be fed. The government doesn't just send you money typically. You typically have to do something in order to get the money, such as file a tax return. And a lot of people found out when the whole stimulus checks came out, which, by the way, a second stimulus check is coming out. So if you haven't filed yet, or if you haven't made an attempt to file, then you probably should get on it as soon as possible. And then here's the sweet thing. As a business owner or realtor, you get to write off almost all of your business expenses. So a business expense deduction, or a tax write-off for short, is basically something that reduces your taxable income. So let's say you grossed $100,000 for the year, so you brought in $100,000. And let's say you have write-offs of $25,000 where your net profit is $75,000. So that $25,000 helped reduce that $100,000 down to $75,000. So now you're only taxed on $75,000 instead of $100,000. It doesn't mean the government is going to send you $25,000 or reimburse you. It simply means that your tax liability is being reduced by $25,000. That's one often common misconception, believe it or not, of people, is they think a tax write-off or tax deduction is money that will be sent back to you. So in order to, when you have a business, especially when you have an LLC or an INC, you get to deduct expenses that are ordinary and necessary. Ordinary means it's very ordinary for an accountant to be paying for licenses. It's very ordinary for me to have a laptop so I can do my work. And a necessary, meaning it's necessary for you to grow your business. It's necessary for me to advertise. It's very necessary for me to have an Apple Watch. It's very necessary for me to have a nice car that I can drive in so that I can go and meet certain clients. Of course, we're 100% virtual CPA firm now. But from time to time, we do travel places, right? We do need to go see our moms and our parents and things of that nature who happen to be clients of ours. So every time we visit our parents, that's a tax deduction because we're visiting our client, right? So you do get to take advantage of the gray areas of the tax code. Same thing with meals, as long as you're eating with somebody. So if you're eating with your spouse or a parent, or your spouse is typically your business partner. Make sure that when you have a partner, that they're your business partner as well. So when you eat, anytime you eat with your spouse, that's a tax deduction because it becomes a business meeting at that point. As long as you're discussing business in some capacity, either before, during, or after the meal. So it can be something as simple as, hey, how many clients did you get this year or this quarter? Let's talk a little bit about the promo video that we're about to shoot. Just some sort of discussion. As long as a discussion does come up during the meal, then it's fine. But all meals that you have with your business partners, those are all tax deductible because you have a business relationship and a business reason for having that meal. Same thing with parents, same thing with loved ones, same thing with clients. Of course, when you eat with a client, that's a tax deduction. You'll be surprised some of the meals you can deduct. I mean, it can go as deep as even weddings. Right? Having a wedding, for example, where you're inviting guests who happen to be business prospects and you put a business card, right, in each of their gift bags. That's a tax deduction. So you can definitely take advantage of these deductions. When it comes to taxes, we don't leave any money on the table. Same thing with travel. When you're traveling with your spouse and they're your business, if you want to bulletproof this, have a board meeting during that time where you have your board meeting documented as to the company, the place of the meeting, who was there, the date of the meeting, and what items were discussed. Sign and date, put it in your files. The IRS will never touch you on that. Same thing with fees. So realtors may have MLS fees, license fees, dues and subscriptions, supplies such as Apple Watch. I mean, you got to tell time, right? So these are all things. And nowadays, we'll save that for the home office deduction. But you get to save a lot for retirement as a realtor or business owner. You actually get to save more than your traditional W-2 employee. And some of your retirement contributions are fully tax deductible. And business owners are in the best position to save for retirement. We also have powerful plans such as life insurance and things of that nature. So you can definitely reach out to me after the fact. We can cover more on some of the specific types of accounts you can take advantage of. But just know that as a realtor or a business owner, you have access to a lot of tax deductions. Lots and lots of tax deductions. So we do have a question here, or I guess a comment. It says, wow, I feel like that would practically be every meal. Yes, that is true. You'll come to find out that almost all your expenses as a business person or businessman or woman is a tax deduction. You know, he says we talk about real estate all the time. And do you need to have board meetings for just an LLC? No, you don't. But you can. You can go to Cancun. You can go to Puerto Rico. You can go wherever you want for your board meeting. Or you can stay in good old Chicago. There's nothing wrong with that. For me, I have all my board meetings in non-Chicago places. So whether it's out of state, whether it's out the country, that's where I typically have my board meetings. So anytime you see me in Jamaica or Puerto Rico or South Africa, wherever it is, I'm probably having a board meeting at some point during that trip. So that's something that you have to keep in mind. Now, if you're like, okay, I don't want to have a board meeting, but I still want to travel and reap the tax benefits of it, then just work about 4 hours a day during your trip, during like work days, so not weekends. As long as you work 4 hours a day, work can mean checking emails, talking to clients, whatever it is. That's ultimately all a part of it. Now let's go into the next thing, is home office. Nowadays, almost everyone is working from home. So you get to deduct all your home office expenses. And I'll show you how to do this in a second. But this here is not some big fancy corporate office downtown. This is a home office here that you see in the background. I've been working from home for the past 4 years. We used to have a corporate office, but we decided to get rid of it because there was no need for it. All of our taxes are done virtually. We meet with our clients virtually, so what's the need for an office? So you can deduct a home office, and typically a home office is a designated area that you conduct business, such as this. This is a room. It's about a 200 square foot room that allows me to do business. This is where I'm taking Zoom calls. There's some storage stuff in here. This is where I do my videos and my webinars. So this is a home office. The IRS can't touch me if they come in here and they try to say, oh yeah, this is not an office. As long as they don't see a bed or something that indicates that it's personal use in that office space or that square footage that you gave them, then you should be fine. So in this one, we use either the simplified method or the regular method. The simplified method is simply we take $5 and we multiply it by the square footage of the office. Very, very simple. The regular method, and that's more if you own a home. If you own a home, you should take the simplified method because then you get to double dip and still count your mortgage interest, property taxes on your Schedule A when you file your personal taxes. Then there's the regular method. The regular method is ultimately when you take, that's more for renters. So you take your rent, utilities. Keep in mind, utilities such as internet and your phone are typically 100% business tax deductible because usually you're using most, if not all, your internet for business-related reasons, especially if you're a full-time entrepreneur like myself. Everything I'm doing is business-related when I'm using the internet or my phone. But other utilities such as cable, gas, things of that nature, you would add all of those up, take the square footage of the office, divided by the square footage of the entire apartment, and then multiply it by your individual items, rent, utilities, maintenance, whatever it is. Health insurance premiums are also fully tax deductible as a business owner. Very important to note. 1/2 of the FICA tax. So remember, I mentioned that you have to pay 15% if you're filing as a Schedule C, sole proprietor, or a partnership. So this FICA tax, you actually get to deduct 1/2 as an adjustment though, not as a credit or anything, but as an adjustment. So that's why it effectively makes the FICA tax deduction, or the FICA tax you pay, only about 10% instead of 15%. But it's still worthwhile. I mean, if you're looking to save 10%, that could be a lot of money. Some people decide to be based in states that don't have any state taxes, such as Texas, one of my favorite states. So that's another tax planning tip or tool that you can utilize. And then consider becoming an S-Corp if your net profit is over $30,000. Keep in mind, remember, this is for active businesses only. This is not for real estate properties or real estate investments. We're talking here about your day-to-day business, whether you're a realtor, inspector, contractor, attorney, accountant, appraiser, somebody who's actively involved in the business. These are the things that you would do as far as like going the S-Corp route. The reason why is because when you have the real estate property investment, you typically don't pay any taxes on it anyway. So you don't have to do any of that S-Corp conversion or anything like that, any payroll or anything like that. So that is one thing to note. I should mention that with the S-Corp, you do have to declare a small salary. Typically, it's about 25% of your net profit. So we do have to declare a small salary in your S-Corp. And we run that through a payroll service, typically such as ADP, where they would send you a W-2 at the end of the year, just like you would if you had a regular full-time job. Now, how do we keep track of all of this? We utilize a software such as Quickbooks. Quickbooks is beautiful, love it. I just had a Quickbooks training with a realtor this morning, which is a service that we do offer. But Quickbooks allows you to automatically download and categorize transactions, participate in online billing, create professional looking invoices and estimates, upload receipts through your phone. So you could do receipts through your phone, and you should always keep your receipts, by the way. With receipts, you either, if it's a digital receipt, then you save it in a folder called 2020 receipts. Or if it's a physical receipt, you simply take a picture of it and then you ultimately store it in your folder somewhere. So you can upload receipts through the phone, create customized financial reports, and then if you do have inventory, you can track inventory. Some of the pros of QuickBooks is that it's a full-blown accounting software. So QuickBooks is the full package. It's the real deal. I told my realtor earlier today and said, hey, for $35 a month, you have an accounting department. So it is a full-blown accounting software that allows you to automatically download and categorize transactions. It has a professional look and feel. If you're looking to send invoices, we send all of our invoices through QuickBooks. It is the absolute best software in the industry, hands down. It's every year they go through a survey and it keeps popping up at the top. And then plenty of discounts offered, especially if you're working with a pro advisor such as myself. So I do offer discounts and incentives for my clients. Saves business owners a ton of time. You're talking 10 hours a month on average, which is huge for how much business owners actually work. So it can save you a ton of time. Instead of manually entering things into a spreadsheet, or God forbid not having anything at all, keeping all your receipts in the shoebox, I mean, you can consolidate all of that and basically set up your QuickBooks, link your business bank account or a personal bank account. Typically, you should be doing, remember, you don't want to commingle, so you should be using your business card or account for all of your business expenses. But it would ultimately allow you to categorize everything. One thing about QuickBooks, you do need some training, so that's why my realtor earlier today decided to sign up for some training. Just a little bit of training just to get the feel of the full-blown features of the software. You could figure it out, honestly, and you could watch videos and tutorials, but we do offer a 1-hour training where we sit down with the client and we go through all of the features of QuickBooks, where they take notes and then be able to refer to it at a later time. So it does need some training. That's one of the downsides of it, but hey, it's one, you do it, you train once, or you become good at it once, and then for the rest of your life, you'll be saving thousands and thousands and possibly millions of dollars once you get to that point. So with that being said, thank you all for joining. I promise that we will leave about 10 minutes or so. We typically leave in all my presentations 5 to 10 minutes at the end for Q&A. So this is a great time for you to ask any questions you have. If you're on Zoom, Zoom is always our main platform, by the way. So if you see me looking into different cameras, then that's because I'm actually on Zoom right now speaking. But I do allow a live stream through Facebook and Instagram. So if you're on Zoom, you can just unmute yourself and ask a question or put in a chat box. I will get to the questions that I see in the chat box. And then if you're on Facebook or you're on Instagram, then you simply type into the chat box and I'll be able to answer that. If you don't ask me a question now, or if you would like to follow up about something or something sounded interesting to you, you can email me at jb@badutaxservices.com. Once again, jb@badutaxservices.com. Phone number 773-679-7198. And with that being said, looks like we're at 12:50. Let's get to the questions. So first question here, is there a limit to how many board meetings you can have? That's a great question. I would say no more than 4. I mean, nowadays with COVID-19, people aren't really traveling anyway. And COVID-19 will probably be here for at least another year or so. So a lot of people aren't really traveling. But in the years that you are traveling, I know somebody who took the 4 board meetings and loved it, every single one. And they came back refreshed. The reason why the IRS allows you to do these things is because they want you to make more money so that they can tax you on more. Until you meet somebody like myself, who I tell you, well, instead of paying Uncle Sam, how about we pay you, or we pay an investment, so we reinvest and divert that money into an investment, such as real estate. Question here is, regular method is for renters? Yes. And simplified is for homeowners? Yes. Because as a homeowner, you get to deduct property taxes, mortgage interest on your Schedule A itemized deductions. So you get to double dip when you take the $5 times your square footage of the home office. All right, so any other questions? Remember, if you're on Zoom, you can unmute yourself and ask your question, or you can just type in the chat box. If you're on Facebook or Instagram, then you can just type in the chat box. We typically leave a few minutes, and if we don't have any questions, then we just call it one for the day. Yes, sir. I'm sorry, what's the question? Yeah, so the regular method is you take the square footage of the home office divided by the square footage of the entire property, or I'm sorry, the apartment. So let's say it's 200 square foot for the office, and then 1,000 for the entire apartment. Well, that's 20%. And then you multiply it by your rent, utilities, and all of that. So that's the regular method. Simplified method is very simple. $5 times the square footage of the home office. Does that answer the question? Yes, sir. All right. One second, please. I'm sorry, can you repeat the question? Mm-hmm. Yeah, so the question was the template for board meetings, is it available? And I would say yes. For those who are on the call, and only those who are on the call today, if you shoot me an email to jb@badutaxservices.com, I will send you a board meeting template for free. So that's the freebie. It is typically part of our core tax planning service, but we will definitely get it to you complimentary today for being a part of this. So yeah, we can definitely send that to you. Question here, do you have to establish bylaws for your company to have a board of directors? That's only for corporations. All corporations need to have bylaws. LLCs don't need to have bylaws. And if you're talking about board meetings is just a one-page document that you document and say, hey, I had this meeting. It can literally be 5-10 minutes. You can have it for an hour if you want. You can say, hey, my board meeting was held at Labadi Beach in Ghana, right? And document that, sign, put in your files, and go in and enjoy the beach the rest of the day. You can do that. But yes, a board of directors is needed if you have a corporation. So if you have an INC, so if your company ends in INC, then you need articles of incorporation, you need an EIN letter, a tax ID number, You need bylaws, a stockholder certificate, and you need to have board meetings or a board of directors, basically. Board of directors would be found in your bylaws typically. All right, any other questions that we have? We still have about 6 more minutes left. And if we don't get any questions within the next minute or so, then we'll just call it one. But thank you all for joining once again. This is recorded, so we do record these trainings or these webinars. And to get that, if you're on Facebook, you simply go to my Facebook page and then you can just watch it there. Same thing if you're on Instagram, just go to my IG Live page or IGTV page and you can get it there. If you're on Zoom, then you can just send me a request and I'll send it to you. But the same exact thing that we're recording is going to be available via Facebook and also via Instagram. So we typically stream it on 3 platforms. Next year we might have 4 actually, depending on what else comes out. So any other questions? Last call for questions before we wrap it up for the day. Yeah, so land trust, I guess land trust is related to the property itself. So this is not, relevant to this webinar specifically. But a land trust basically allows you to protect your property itself. When you have a property in an LLC, well, guess what? Somebody can still sue the LLC and get that property. But if it's not in, basically, if it's in an LLC, then somebody can sue and get the property. However, if you want to protect the property itself, you would set up a land trust so that the land trust protects the property itself. Meaning if they sue the LLC, when what's in the LLC, they won't get anything because that what's in the LLC is a land trust that owns the building. So the land trust owns the building, and then the LLC is the beneficiary of the land trust. And it also gives you privacy, meaning that if somebody were to look up who owns this building, right now everything is public record. I can see where everybody lives, right, if you own a home. But if it's in a land trust, it's going to say Chicago Title Land Trust number 1234567. That's the owner of the building. So it gives you that nice privacy that that you need, and then also it protects the property itself. All right, so we'll do one more call for any questions. All right, doesn't sound like we have any other questions. So thank you all for being a part of this. Let me go ahead and stop the recording on Zoom. And let me go ahead and end the live stream on Instagram. Thank you guys for joining. So the live stream on Instagram has been ended. Let me go ahead and end the live stream.